Welcome to another FAR walkthrough video. I'm Logan, and in today's video we're going to be going over calculating foreign currency transaction gains and losses. And by the way, that is important. Different than translation gains and losses, that's something that's on bar now, but transaction gains and losses. And we're going to be doing that the SuperfastCPA way. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training where we teach the key ingredients to passing the CPA exam. Again, it's only 1 hour, it is free, and we will teach you how to be effective and efficient with your study process so you don't waste any time. Also, just letting you know, we will only be going over 5 questions in this video, but SuperfastCPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a SuperfastCPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1. On November 1st, year 1, Sunflower Corporation, a US-based company, sold goods to a customer in Germany for 100,000 euros, with payment due on January 31st, year 2. The spot rate on November 1st, year 1 was $1.10 per euro. The spot rate on December 31st, year 1 was $1.15 per euro. The spot rate on January 31st, year 2 was $1.12 per euro. What is the gain or loss recognized by Sunflower Corporation in year 1 and in year 2 related to this transaction? Okay, so if you don't know much about these foreign currency transactions, that's okay. But basically, you have to figure out what is the gain or loss on certain dates using the spot rates. So if you don't know how to do it, that's okay. Let's go ahead and go straight into the answer to learn it. All right, the answer is B. There would be a $5,000 gain in year 1 and a $3,000 loss in year 2. So let's walk through this and why that's the case. So November 1st, year 1, the initial transaction is recorded at $1.10 per euro, which in this case is 100,000 euros multiplied by $1.10. That gives you $110,000. So they're expecting to sell these goods for $110,000. But by the end of the year, and you have to do this at year end, you have to reevaluate. Now the exchange rate is $1.15 per euro. So now they're expecting they're going to earn $115,000 instead of $110,000. So they recognize $5,000 gain in year 1 at the year end because, again, the exchange rate has gone up for dollars to euros and they are selling these goods. So that's why they're expecting this gain. But when it comes January 31st, when the actual payment is received, they're actually getting the money for these goods that were sold. Now the exchange rate is $1.12 per euro. So we have to multiply the 100,000 euros by the $1.12 exchange rate. That gives us $112,000 that was actually received on the payment date, meaning that they also had a loss compared to what they were expecting to get of $3,000 because they were expecting $115,000 and now they actually received $112,000. So there is a loss recognized in year 2. So basically, you have to take into consideration what the exchange rate was on the day that the transaction started. Then you have to take into account if the exchange rate had changed by the end of the year before the payment has finished. And then on the actual settlement date, you have to take into consideration any other changes that have happened. Let's go ahead and do the other questions to continue learning a little bit more about this, to make it sink in. Here's question 2. On August 1st, year 1, Maple Leaf Corporation, a US-based company, sells goods to a customer in Japan for 15 million yen. I believe that's the correct way to say that. Payment is due on November 1st, year 1. The exchange rates are as follows. On August 1st, when this is all initiated, it's $0.0094 per yen. And in November 1st, year 1, the day that the actual transaction occurs, it's $0.0095. So it increased by 1 per yen. Who between Maple Leaf Corporation and the customer in Japan recognizes a gain, and who recognizes a loss, and how much is each gain or loss? So how does this work? Do they both recognize gains or losses? Does one of them not? Let's think about it. And when you're ready, come back. We'll look at the answer together. Okay, the answer is that Maple Leaf Corporation would have a $1,500 gain, but the customer in Japan wouldn't recognize any loss in yen. And this will make sense when you think about it. First off, for Maple Leaf Corporation, they were initially expecting to record a sale at $141,000, which is 15 million yen multiplied by that $0.0094. And then on November 1st, they actually received the payment, but they received it at $0.0095 per yen, which is actually $142,500. So they were expecting $141,000, but they're actually going to get $142,500. So they actually have a gain recognized of $1,500. Now, when it comes to the customer in Japan, they agreed to pay 15 million yen. It doesn't really change anything for them because the exchange rate was in dollars. It was 1 yen equals this many dollars. And again, they agreed to pay 15 million yen. That's it. So no matter what the exchange rate was, that is how much they're going to pay. So they don't recognize any gain or loss, they just pay 15 million yen. All right, let's go to the next question. All right, here we are at question 3. On October 1st, year 1, Sierra Enterprises, a US-based company, sells goods to a customer in Australia for 500,000 Australian dollars. Payment is due on January 1st, year 2. The exchange rates are as follows. On October 1st, year 1, the day of the initial beginning, that's 70 cents per Australian dollar. December 31st, year 1, 72 cents per Australian dollar. January year 2, 71 cents per Australian dollar. What is the gain or loss recognized by Sierra Enterprises on the financial statement date December 31st, year 1? So what is it specifically on the December 31st date? We've already learned pretty much how to do this in the previous question, so let's have you do the calculation yourself. Pause the video if you need to, and come back when you're ready. All right, here is the answer. There's a $10,000 gain. So let's think about this. October 1st, year 1, the initial transaction is recorded at 70 cents per Australian dollar, which is 500,000 Australian dollars multiplied by 70 cents, and that gives you 350,000 US dollars. Then on December 31st, year 1, there's a reevaluation at 72 cents per Australian dollar. So now that's $360,000. So again, they're expecting to receive, as of December 31st, $360,000 instead of $350,000 that they were expecting in October. So as of the end of the year, December 31st, they have this $10,000 gain recognized. Now that's all the question is asking. But if you look ahead, literally the next day, January 1st, the rate has actually gone down by 1 cent. So that's going to affect them on January 1st. But as of December 31st, they are recognizing a gain of $10,000 because of that rate changing. Let's go to the next question. All right, here's question 4. On March 1st, year 1, Oceanic Ventures, a US-based company, purchased raw materials from a supplier in Brazil for, and I think I looked this up to understand how to say this. It's a Brazilian real, or I think the plural is reais, which I'm not 100% sure if I'm saying that right, so maybe let me know. But the payment was due on June 1st, year 2. The relevant exchange rates are as follows. March 1, year 1, 20 cents per reais or real. December 31st, year 1, 22 cents per real. And June 1st, year 2, 18 cents per real. So, after looking at all that together, we have to identify the accounts that will be impacted on March 1st, year 1, and June 1st, year 2, and we also have to calculate any gain or loss that happens on that payment date. So we've done this all before in the previous questions, but you have to think about the journal entries and think about what is the gain or loss that's going to happen on the payment date. But you have to walk through this whole thing. So pause the video, do all the calculations, and when you're ready, come back, we'll look at it together. All right, here's the answer. On March 1st, you record in accounts payable and inventory, and then on June 1st, you record in accounts payable and in cash, and also you record a gain. So let's walk through this and why there's a $40,000 gain. So on March 1st, year 1, the spot rate is 20 cents per Brazilian real. So that's $200,000. You debit inventory for the $200,000 because they got the inventory, they just haven't paid for it yet. So you credit accounts payable for the $200,000. On December 31st, year 1, so at the end of the year, you always have to do this at the year end, you have to revalue. So now it's 22 cents per real. So that's $220,000. So you have to take the original $200,000 and subtract the $220,000 that now you're expecting to pay, which is a $20,000 loss because they were expecting to pay only $200,000, but now as of December 31st, they're expecting to have to pay $220,000. So you debit foreign exchange loss, which again, that's a loss on the income statement, $20,000, and you credit accounts payable up to $20,000 because again, you're expecting $220,000. And then finally, on June 1st, year 2, the actual payment date, on that date, you have to revalue as of the spot rate, which is 18 cents per real. So $180,000. You take the $220,000 that you were expecting on December 31st, subtract the $180,000 that you're actually paying. So there's actually a $40,000 gain because you're paying $40,000 less than you were expecting. So you have to debit accounts payable, the full $220,000 so that you just completely get rid of it. You credit cash for $180,000 because that's how much you actually paid. And you credit foreign exchange gain for the $40,000 of a gain that you weren't expecting to have as of December 31st. Okay, so as you can see, there's a lot of things that can go into this, a lot of different journal entries. So with that, we're going to go to the next question. All right, here we are at question 5. Crystal Springs Inc., a US-based company, did business in Canada on January 1st, year 1. Crystal Springs Inc. pays $1 million Canadian dollars on December 31st. The relevant exchange rates are as follows. On January 1st, year 1, the exchange rate is 75 cents per Canadian dollar, and on December 31st, the date of the payment, it's 80 cents per Canadian dollar. So which currency has appreciated, and how does this affect Crystal Springs Inc.'s financial statements? So think about it. What does it mean to appreciate? What does it mean to depreciate? And come back when you're ready. Okay, the answer is that the United States dollar has depreciated compared to the Canadian dollar, or it could also be that the Canadian dollar has appreciated compared to the US dollar. But of the answers that were provided, the US dollar has depreciated, and Crystal Springs Inc. recognizes a loss on the financial statement due to the decreased value in the United States dollar. So let's walk through this. When one currency appreciates compared to another, or one depreciates compared to another, it means the value of the appreciating currency has increased relative to the other currency, or vice versa for the depreciating currency. In this scenario, the Canadian dollar has appreciated against the US dollar, or if you look at it the other way, the US dollar has depreciated versus the Canadian dollar. Pretty much the same thing. So as of January 1st, they were expecting 75 cents per Canadian dollar, meaning they were expecting to pay $750,000. But on December 31st of year 1, they have to reevaluate, and again, that is the day of the payment. So on this date, it's 80 cents per Canadian dollar, so they're going to pay $800,000 because that's what 1 million Canadian dollars is worth in United States dollars. So you take the initial expected amount, $750,000, less the $800,000, and that's a $50,000 loss recognized by them. So when the Canadian dollar appreciates, or again the United States dollar depreciates against the Canadian dollar, the value of the Canadian dollar increases in terms of US dollars. As a result, Crystal Springs Inc. recognizes a loss of $50,000 on its financial statements due to the increased cost of the Canadian dollar from 75 cents to 80 cents per Canadian dollar. All right, we learned a lot. It's all very similar though in this video. It was just a few different scenarios. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up, the things that you keep needing to learn and recalculate. You keep seeing explanations and equations that look similar to what we were just barely looking at. So you notice those things and you take a second and you write them down as pillar topics so that you know them for later. Let's go ahead and look at the pillar topics for this video. Alright, here are the pillar topics. Transaction gains or losses occur when the exchange rate changes between the date of the transaction and the date of settlement, impacting the value of foreign currency denominated monetary items. When a foreign currency transaction is recorded initially, it is recorded in the functional currency, most of the time that was the United States dollar in this case, at the spot rate on the transaction date. At the financial statement date, which is almost always year end, monetary items denominated in a foreign currency are revalued using the spot rate at that date, resulting in recognition of a gain or loss. On the settlement date, same thing, the foreign currency amount is calculated using the spot rate on that date, and the difference from the revalued amount at the financial statement date, if that was necessary, results in a gain or loss. And then finally, currency appreciation occurs when the value of one currency increases relative to another, resulting in a gain if the functional currency appreciates and a loss if it depreciates, and vice versa for foreign denominated liabilities. And basically another way of iterating that is currency depreciates when the value of it compared to another is decreased, and that can cause gains or losses as well. Alright, those are the pillar topics, and with that, that is the end of the video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it is free, it is only 1 hour, and we will teach you the key ingredients to passing the CPA exam, and we will teach you how to be effective and efficient so you don't waste time. If you liked going through these 5 questions with me, just remember that Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.